Hey guys, welcome back. My name's Aaron. This is Czar Finance, episode 15, Investments 101, and about disappointments. Now, in today's episode, I'm going to talk to you about the emotions that you can face when investing, taking your money that you've worked for, and investing in something that doesn't go your way. Now, I don't want you to get caught up in the emotional tallies of, oh my gosh, this didn't go right, I lost my inheritance, I lost my house, oh my gosh, oh my gosh, oh my gosh. The big thing you got to make sure that you're thinking about is when you take the money, as in the last episode I talked about, when you take, let's say $100, you got to make sure when you invest it that you've already lost that money. You have no emotional ties to it. You have to pretend like you've already lost it. So anything that is a gain is a plus, but if you happen to lose it, it's not going to break, be the end of the world. You just lost your money and, okay, you can write that off and just feel like, you know what, hey, at least I tried, I played around with it. But I don't want you to get emotionally tied to that money, because that's when things can get critical to you. You start to get the highs and the lows when the market goes up, when the market goes down, and people start to see those emotions. You get very angry or angst or start to sweat, or you get nervous and you can't think about anything else. You're like, oh God, oh God, oh God. Oh man, and then it causes stress, and when you have that stress, it causes a lot of things to go bad, and your blood pressure may rise. Bad things start to happen all around. So I don't want you to have that effect on you, because the vibe goes out, it casts out from you, it just kind of bubbles out, and people start to feel that vibe, and they start to say like, whoa, what's wrong with you, or what's going on, or is there anything you need to talk about, etc. And it's all tied to emotions when investing. So remember, when you're investing in something, make sure you have no emotions to it. The stock market goes up, it goes down, it goes sideways, it goes any which way you want to go, but it's very unpredictable. A lot of people say, oh, well, I think, obviously you do your research when you invest things, but a lot of people say, this is a sure thing. This is an absolutely sure thing that you should invest in this XYZ stock. It's going to go up through the roof. Oh my gosh, put all your money into it. It's going to make you a millionaire overnight. Well, if you do that, 99.9% of the time, the money's going to tank. It might go up for a little bit, but then it's going to tank right after. It's called what's called like a fake pump and dump. You basically, they're pumping up the stock, and then they dump it right out. They jack everybody else to put all their money into it, and then the investors or the people who set up the XYZ company, they pull all their money out, and then they leave everybody broke as a joke, and you crying the blues for, oh my gosh, where's my money? I have no money left. Oh no. So I don't want that to happen to you. I want you to do your research, be aware of what you're going to be investing in, research. How long has the company been around? Does it seem like it's a valuable investment? And when you decide to do that, be ready to have a disappointment if the market goes up or down. Say it does go down, and not to be, just to take it as a loss. Just realize, you know what? Okay, it didn't work out for me. I'm gonna take it as a loss. I'm gonna sell some stuff, or I'm just gonna get rid of it, and that's that. Don't be afraid to not go back into it. I don't want you to get scared away by these investment things, because investing is a very successful way to increase your income. But I don't want you to be scared, or when things go south or whatever, because things happen all the time. The market crash of 2008, etc. It's not really a crash. It was just like a slight dip in the market. It's more of a correction, which needed to happen, which often scares me now of what the market's doing, how high it's been going. There hasn't been a real big correction with that in time, which really does scare me as far as some things, with everybody's money being pulled into one egg, if you will. And then if it does liquidate, there's going to be a lot of people who are going to be, hurting from that and not realizing that. But all in all, don't let your emotions control you. What is the market? A lot of people ask me, what is the market? Well, the market consists of a whole bunch of different little companies and big companies combined together. And when certain markets go up, certain markets go down, it's all relative. So say you're a small investor and you invest in a small caps company, maybe, let's just say, I don't know, just like the local shop down the street or something that they went public, and you invest in them, and you like startup companies or whatever, you can always invest in them, and you're hoping, well, if one of those hits, it's going to make a lot of money. Well, you never know. One of those companies might go bankrupt. Who knows? Or maybe you're another investor type who likes to go with large cap companies, the big, the Apples, the Dells, the Googles of the world out there, and feels that they are a strong company. They're never going to go bankrupt. Well, you never know. They can go bankrupt just as well as the little guy can. It's just in a different factor. So don't get caught up with the emotions. Again, let that ride. Don't jump to conclusions. Be careful of watching the news, the media. If the news or the media is already telling you about the company, it's actually already happened. The inflation of the price is probably at its peak. So don't listen to the hype. Don't even look at the hype. You know, they're always talking about this company. So Apple hit, you know, new iPhone sales today. You know, oh my gosh, I'm gonna go invest in them. Oh my gosh. Well, they probably did that like 3 months ago, and they're just reporting on it now. Or yeah, they might have had a product release last night, but it doesn't mean the product is going to be great sales. So don't jump to the media or don't jump to the hype if somebody has a great tip for you. Do your due diligence and do your research. Find out what it is that you want to invest in before you put your hard-earned dollars into it, and then let it sit for a little bit, see what happens, and take it from there. And then hopefully the money will rise, and then also know when to pull out, when to say, hey, I've made 8%, I've made 9% of my money. I'm going to pull out. Maybe I made 100% of my money. I doubled my money. Oh my gosh, you know, what do I do? Is it time to pull out? When is the right timing? And I'm going to talk to you guys about that in a later episode. But for right now, don't let your emotions control your investing. Stay calm, relax. You know, the market goes up, the market goes down. Hang in there for a little bit of long term. Usually a long-term investment is a better investment if you invest early. The longer term, I talked about time. The more money you generate, as you know, compound interest goes, dividends are ways of bringing back in money from the company, reinvesting into the investors who invested in them. And on next week's episode, we're going to talk about again investment 101, and this time we're going to talk about stocks in general. Okay, we're going to talk to you about types of stocks, what are stocks, what is it comprised of, what is a stock. So we're going to break that down, and there's a lot of different categories from stocks to mutual funds to bonds, to a whole bunch of different things, and I'll break that down for you. Thanks for joining me. My name's Aaron. This is Czar Finance, episode 15. That's that.